Hey everybody, this is Kingscrowd Investment Roundtable. Welcome to another great edition. This week we're going to be diving into some of the regulation changes that we may see in 2025, what that may mean for both online startup investors as well as founders. We're also going to be diving into the chart of the week this week, where we looked at some of the top platforms in equity crowdfunding and how they stack up in terms of their actual campaigns and how much are raised. So it's about 1 week into the new administration here, and there's been a flurry of executive orders and other changes flying around. But one of the things that we are definitely paying attention to are the potential impacts on the regulations. Now, regulations, as a reminder, all of this capital raising, everything that happens when you're raising capital online, when you're investing in startups online, happens through these different exemptions that the SEC has put in place. We tend to focus on Reg CF, regulation crowdfunding, and Reg A. Now, some of the things that have just come out over the past week, for example, Andreessen Horowitz, A16Z, a very famous VC firm, put out their new digital age at the SEC memo, where they actually mention Reg CF as a potential pathway for crypto offerings in the future and some proposed changes there. We've also seen Commissioner Peirce at the SEC, she's one of the commissioners, was now the head of the new crypto task force. And then we've just heard lots of other changes in terms of proposals, bills around capital formation. Scott, you are very involved in this ecosystem and kind of like private market investing, democratizing that for the investor. What do you think is going to happen in 2025? What can we look forward to here?
This is going to be the arming year. This is the year where people are, for the first time, everyone who probably criticized and laughed at you and me, Brian, and Teddy and Leia, probably when you said analyst at Kingscrowd, they probably snickered. They're all going to enter the arena, as our non-friend Chamath would say. I just see activity everywhere. I see people loading up and trying to learn a lot. I see people talking. We'll get into the A16Z thing, but I see people talking about Reg CF like it's shit that's coming out of their mouth for a decade, and it's like 5 minutes old and they don't know anything, and they're going to get into it a little bit and then realize it's not what they thought, and then they'll whatever. But like, I think 25 is a year of buildup. I'm not totally. So I would love for this to work out, but I'm not totally sold that 25 is the year that it all goes bang. I think 26, 27 is the year you're going to see a couple of big moves. I know, Republic had the announcement with Hamilton Lane, and I literally just had the CEO, Kendrick Wynn, on my show, the CEO of Republic on my show, Technori, which is happily relaunching. There's my plug. Check it out. But we talked a lot about the regulatory environment, in particular around crypto and tokenization and that impact when it starts getting to retail investment. And I'm going to blank on the name here. It was not Pomp, but it was in the Pompey world, who said that one prediction of 25 and 26, and I think you're kind of seeing it already, is this like weird merger of public markets and crypto, and like they're kind of taking from one another. Private markets is like basically the bridge that, like, I think everyone has disagreed. RWAs and private is the bridge to that. And so I think I'm going to say this and then hand it back to you, Brian, to keep this going. I think you're going to see things like people like Andreessen Horowitz, who look at what regulatory has looked like historically for crowdfunding. It's been slow. It's been inert. It's not really been something that's helped us out as those who are working in the space, viewing it as something that money can solve. And they've never run into regulations that they couldn't get past. And I think that they're all looking for new access to capital and wealth. And I think that one of the biggest problems of the crypto era, and you're seeing it every day now with tax evasion things and all kinds of stuff, is how crypto is regulated, how it is taxed. Is it a security? Is it speculative? What is it? And I do think that a lot of the people have been paying attention to the regulatory part of crowdfunding, not crowdfunding the equity crowdfunding, but the regulation component of this. I think they recognize that this is just like you mentioned, this is like Republic has done or tried to do with the note. They've realized this is a way for you to securitize crypto in a legal way, where a fiduciary like Andreessen Horowitz can actually conduct business in a normal way instead of it being some weird shit offline. That's a really long thing you didn't ask for, but you got it anyway.
Yeah. Well, yeah, the way I think of it, it's like kind of a spectrum where, the ICOs of 2017, 2018, completely unregulated. You just post a white paper, money flows in like that. A lot of those, most of those.
Really wish I got into that.
Fraud, right? It's the number of rug pulls and everything else, right, that happen. That's why we have some of these anti-fraud provisions. But then you step along that spectrum, and Reg CF is kind of the next step, where it's not full-blown public market disclosure, but it's like, hey, we're going to do some minimal checks here and at least make sure this is legit in some way. So I think it'll be interesting to see, with so many more pro-crypto people now in places where they're kind of pushing some of this legislation, is the final result a compromise? Like, is it a little bit more than the ICOs, but less than Reg CF? Or is it tweaking Reg CF, increasing the cap to allow a higher limit? There's a lot of different changes. And we're talking about, crypto from the A16Z thing, but this applies more broadly just to, there are still a lot of people in the industry who want the cap to be 10 million or 20 million or 25 million for Reg CF because, grand scheme of things, yes, that's a lot of money, but it's still not that much. And is the amount of disclosure required to allow someone to invest $1,000? This is the thing you hear all the time, and I totally agree. But it's like, we let anyone go to a casino and you can gamble your whole paycheck or life savings and put it on red on a roulette table, but we won't let you support a founder of a company where you actually might have a good chance of getting some money back. So that's kind of where I stand in the position. But
I got to be honest, I'm 10 years into this, and I like your bet on red a lot more. I'm not going to lie. No, but jokes aside, a couple of things you said there, I just want to hit on. One, it'll be 10 to 20 million. That number is going to go up. It is going to go up because there's several $1 trillion on the sideline. And if you're talking about, what have we talked about? 1.2, $1.65 billion market, depending on who you ask and what day. That is the smallest, shittiest performing fund that A16Z has. That's our whole market. One of their little fiddly funds. If they decide to get in the space and they want to play in, it's going to open up trillions of dollars in capital into the space. And by this space, I mean online private market, not equity crowdfunding, Reg CF into startups. The whole shit opens up. That regulation will be gone and moved faster than you can honestly spell Kingscrowd. It has always been a money play. The thing about it, though, that I think is really funny, and I don't really know how to describe it. I'm going to try, but I don't think I'm going to get it right. We have, in crowdfunding, we've always been, like Brian in particular, between you and I, always have been so protective of the space and so critical of potential bad actors. And we have flags on Kingscrowd's site for this. You built updates on the site to make people aware of when things go, maybe potentially awry. And here is the crypto, ICO, NFT, I name your little acronyms. The rug pulls are in the fucking million, not dollars, millions of times. I can personally name companies and founders who have, in my opinion, been shifty or shady or shilly under the Reg CF, Reg A, Reg D world. And I couldn't name, I would run out of fingers and toes and arms and limbs, just naming the handful that have happened in the last 9 months. We just had the Trump of the President of the United States just pulled it. When Trump and Melania coined before they got elected. And before that, you got the Haktua girl. And I haven't seen her ever since. So I'm not sure what is going on with that. But literally, this happens all the time. And we're talking about billions of dollars, billions. And there's no regulation. And here in Reg CF land, we're like, this person might have ripped us off out of the tune of $1 million. It's like, we have to be, we have to be louder. Look, this is a big business. This is a multi-trillion-dollar asset class. These investors are potentially, when you look at the millennial, everyone on this call, and hopefully the people listening, the millennial investor and the biggest generational transfer of wealth ever in the history of humanity is going to happen over the next decade as our parents age out of life expectancy, for lack of a better term. All this money is going to fall here, and we're all very digital native investors for the first time ever. So I just think 25 is absolutely inevitable that all these regulations are going to move, and It's not that all the people before didn't have money or clout or influence or knowledge or legal access or whatever with lobbying. It's just the timing wasn't right. And we just hit a point now where the tokenization and technology has like met like the demand.
It's catching up.
That's
why
we're
I think
here.
Like if that in 2017, 2018, that's when ICOs were like really becoming a thing.
Right.
If that timing didn't happen at the same time, a lot of that retail investment might have gone into the crowdfunding companies that were kind of coming online at the time. But I think it stole a lot of that demand.
You saw that in COVID. It would have.
Now it's catching up where it's like, hey, actually, these things are kind of, there's overlap here. So,
well, and then the last thing on this, like the other part is the actual quality. Like, because of a myriad of probably a separate podcast of reasons why private investors are now interested in the plumbing and the hand-to-hand business, and this generation, the millennial, who they've like ignored purposefully for 20 years. Now all of a sudden they're interested in us because we make enough money. We have not had as many kids, not as many responsibilities. Our parents are going to die and give us a bunch of money. Like, there's all these reasons, but the asset classes themselves need new capital. And it's like ICO was a white paper and some bullshit scam for the most part. And then NFT is the same thing. Like, I'm just going to peg this random picture. Like, it's bullshit. Now we're in a space where it's like, no, it's not about the token. It's about the blockchain tech. It's a contract. I could actually take real world assets and peg them to something that enables a more efficient flow of capital. And you could be an owner in there could be 1,000 of us who co-own a manufacturing plant in Chicago that generates $20 or $30 million a year. And we own that. That's an income generator for all of us. And it's just stored on blockchain. And that just opens up a whole different way of innovation. I think that is like the driving force is that there's actually finally something to invest in. That's a big part of this.
Well, it goes back to something, I don't know the quote. I don't remember. I'm not going to paraphrase it, but it's essentially like the future businesses, unicorns, technologies of tomorrow are the things that look like toys today. And I think that's how this started with a lot of the crypto stuff, a lot of the NFTs and everything. It's like, it's just this weird thing. I don't know what it is. People are doing kind of, who knows what they're doing with it, but the blockchain, the technology, as that matures, then it starts unlocking a lot. We're seeing that with AI today. I think it's kind of started as like a gimmick of, oh, that's cool. You can have it write in a poem in the style of a pirate. And now, it's doing really good coding and other stuff. So
I think we are really at a dawn of a new time, and I'm not trying to get behind something that it's like, oh, it's popular right now. This is so different from all the other times you just described, for the instance that they all collectively meet here. We're in this AI age, which has massive kind of still projected but unknown impacts with AI on jobs. You're just like, everything has lined up to this place where, like, if there was ever an incentive to move forward with something, this is the time. And I just don't see people who have the means letting that slide, like skipping the opportunity to use the regulation that all of us have spent a decade trying to legitimize.
Awesome. We'll wrap that up. Thanks, Scott, for your input on 2025. We're definitely going to keep tabs on what's happening there. I want to transition over. Welcome Teddy and Leah, Kingscrowd investment analysts, to the discussion. How about we jump into the chart of the week this week? So Leah, you put together some great data where you took a look at the top 5 funding platforms and did some takeaways in terms of the investment sizes and the amount raised. I'll pull up the chart. Why don't you bring us into the data though?
Yeah, actually, a couple of weeks ago, I had a funder reaching out telling me, look, I want to start a new raise. I don't know which platform to go to. And all of them are showing me that they have many companies that raise a couple $1 million. That's great, but I want to know what is the real picture looking like? How much money should I actually expect to raise? And I think that's a great question, not only for funders, because they want to know which platform to pick and what to expect, but also for investors. Because when you invest into a raise, you have to know that the amount of money that is going to be raised by the company is going to fuel its growth. So if you're already investing at a raise when it already, raised about $100,000 from investors, how much can you expect the raise to go up? And do you think that's going to be sufficient for the company to grow and give you a good return on investment, or at least until they can raise the next round? So that's very important for investors as well to look at this chart. What are we looking at here? We took the 5 platforms with the highest number of raise, from the last 18 months. So all the raises that started raising after July 2023 and already closed by December are represented in this chart. And we show you a bar chart to really give you a concrete idea of what are the total amount raised by startups on these different platforms. So here, for example, if we take the case of net capital, you can see that 25% or more other companies are actually not raising more than $0. They're raising nothing. So about a quarter of net capital investment raised absolutely nothing. When it comes to WeFounder, it's different, right? About 25% of the companies raise somewhere around $50,000 or less. And it's kind of similar for Republic. I think startengine is around 60K or something like that in that data. And for dealmaker, it's way higher. 75% of the companies are going to raise $100,000 or more, which is the median, more or less the median amount raised for wefunder and Republic. So what we can see here is that platforms are performing very differently. And I think that there are a couple reasons for that. One of them being the choice that these platforms actually make in terms of which issues do they feature on their platform. Any of you want to let us know a bit more about, what are the choices on wefunder, Republic, dealmaker, if you have any insights?
Yeah, well, dealmaker is pretty unique. I think, Leah, you touched on this in your chart of the week write-up, but where it really gives issuers control over how they create their raise page and how they market themselves. And in exchange for that, they are kind of a bit on their own in terms of having their own mailing lists to find potential investors or existing investors, whereas kind of the start engines, the wefunders, you kind of have to fit within their mold of a raise page, but in exchange they'll market you pretty heavily to their investor group. So so it's just kind of a different model there with dealmaker, but they also tend to be significantly more mature companies, so they tend to generate more overall investment and excitement within the industry. So just different. Dealmaker's kind of stands alone in that sense, I would say.
Dealmaker's kicking everybody's ass, and that's not going to change. I'm just going to put it out there. First off, the founders themselves, like, are literally their deal makers. Like, the irony is on purpose. I have thought that from the minute they entered the space, I was like, shit, because they treat this space in a proactive manner and not a passive manner. And I think the one thing that we can all agree on after, I don't know how many deals you guys have gone through, 6,000 probably between the two of you, at least, maybe more. The past of equity crowdfunding where investors would just come to a website and like click and poke and search was like this dream that kind of came from Kickstarter and people looking and sifting through products. And it was like, oh, I want this backpack. Like, that's just not how this has gone. Hobby investors are very passive, and the platforms that are passive, I think, are falling behind more and more and more and more and more. And they all start kind of reaching for, different kinds of businesses to try to make up the difference. And then it leads them kind of like Net Capital. Again, no disrespect to Net Capital, but they basically had to pivot into a certain way. Republic kind of the same thing. Like, they found an area that was good for them, and then they pivoted to that. Dealmaker has literally been like, if I could take a broker dealer and say, go buy 7 million accredited or unaccredited people's mailing list and just go to fucking town, like, that's Dealmaker. I'm so impressed with what they've done in such a short amount of time. And I think that you're going to see, more likely than not, the other four on that list are going to start acting more like Dealmaker than the reverse. That's my prediction.
So just to jump in, something you said there is so true and something we've seen. Dealmaker came in and they were I believe a broker dealer first. They were one of the few broker dealers in the space with Dalmore, Rialto Markets, a couple at the time. What we're seeing is this huge shift where lots of the funding portals, these are kind of just the two different crowdfunding intermediaries that can do offerings. Broker dealer, you can think of as they're a little bit more highly regulated by the SEC, FINRA. Funding portal is kind of like a broker dealer light model, but all of the funding portals are, I won't say all, many of them are transitioning to use the broker-dealer arm. So Net Capital just recently got the broker-dealer license. They're going to start doing more Reg A, and that also includes Reg D offerings. StartEngine has been using their broker-dealer for more offerings. We've even seen them pause certain offerings and then launch it again with the broker-dealer arm. So there's lots of platforms out there. Silicon Prairie is another one off the top of my mind, shut down their funding portal business because they said it's not worth it. We have more flexibility, and we are able to do more for our issuers for raising capital using our broker dealer, because you can approach investors, you can solicit investments, you can make kind of recommendations based on suitability. These are things that funding portals cannot do. So it will be very interesting just to see as the industry kind of shifts, if it goes more to that broker dealer model, and then what that means from an investor perspective.
If we put kind of net capital and Republic aside, we also see that the number of deals on the platform influences kind of that median amount raised. So wefunder, startengine, dealmaker are the top 3 platform right now. wefunder had 44% more raises on the platform than startengine in the data set that we picked. And as we can see, that lowers the median amount raised on their platform by about half. Dealmaker had even less deals than startengine. And so similarly here, I think they're really a choice of the platforms where wefunder, we kind of let everybody come in and see how they perform. startengine has a selection process that is a little bit tighter, and dealmaker, it seemed that they are focusing on companies with a little bit higher valuation and higher revenue than wefunder as well. So that also plays. If you're a founder, it's important for you to choose the right platform based on the amount of money that you want to raise. If you want to raise $1 million, maybe dealmaker, if you can get on it, is your best choice. If you think that 200,000 is enough for you and you can get on wefunder on startengine, that will probably be enough for you. You may not need to go to dealmaker. If you're an investor, it's also important for you to know which platform you're investing in, because that kind of tells you how the raise is going to perform before it's closed and how much is going to be able to grow things to this capital.
Leah, I just want to co-sign on that with you. We've talked, I don't know how many episodes of this we've done, and I don't know how many charts of the week since I got involved with Kingscrowd we're at. It's, a couple of years worth. Republic has basically that entire time been like in the same general spot, plus or minus. And I think one of the things that's really, really funny about it, and not to, again, plug my aforementioned podcast with Republic Ken, but he basically said, like, we found that the portal CF business was not sustainable relative to the valuation of our company, right? And they have done nothing with their portal except just become more selective and put less resources. And the amount of capital that they're generating through the portal is basically the same as when they were doing twice as many deals. The same general amount has come in. And I think I'm a huge fan of wefunder, and I definitely, this is not a shade. This is Scott's personal opinion, not associated with the business of anyone on the show. I think that wefunder is like Silicon Valley's version of crowdfunding. It comes out of YC. Nick is super smart. I love the company and the team, but they have almost adopted the Silicon Valley high volume, shoot buckets, get the buckets up approach to that business. And I think that in order for them to be right and that to win, they have to either get all of the best startups in Silicon Valley that are known on their platform, not just like once every couple of quarters they get one. It's got to be like where all venture goes, or the whole power dynamic of investors has to change. The hobby investor has to suddenly wake up one day and go, I am a VC, and subscribe to Edge and immediately start investing hardcore. And that's not going to happen. The subscribe to Edge part will happen, but the other part will not. We literally need that to happen. And I think if you look at the chart, it's like paints the exactly where this market's gone. If you look at each individual one of those platforms, they tell a story. Brian did a great job about, and so did Teddy with regard to Dealmaker, and Brian did with Net Capital. Each one of them has like done a thing, and that chart represents it so well. I just think if you're a person who likes this industry that we're talking about, I think it's a really fascinating time and a really fascinating chart, to be honest.
As an investor as well, you have to remember what is the interest of the platform. They're going to make money based on the amount of money that a deal is going to raise, not on the return that you're going to get on your investment. And that's why they may accept a lot of companies that may be terrible investment opportunities, but just because they know they have strong following and people are going to invest into it. And that's why it's really important for investors to, really do their due diligence, use Kingscrowd to try to understand what are the deals that are really going to make them money. And sometimes a deal can raise a little amount of money online, just be able to raise a lot of offline, and is going to be able to make them a lot of money. I know we, for example, invested recently in Kinetic, Earthgrid, which are companies that have been raising a good, reasonable, somewhere around 1 million online, but they're raising way more millions offline as well. And that's something we know because we do the research. So it's important as an investor to get access to that research.
You got to keep in mind some of the missions of these portals. I think with wefunder, Brian, you can correct me if I'm wrong, but they're sort of into that whole democratization of like they want anyone to be able to raise, even if they're mom and pop, but they don't necessarily have a lot of insight into the investment world and private markets, but want to still allow them to kind of raise money and not have to, spend a whole lot to get up and running. I don't know. That's kind of been my impression of them. I don't know if that's true, but
yeah, it's, I've been saying this for a little while where this industry really has two types of companies that raise. It's the ones that are trying to be the high growth startups. They want to be venture backable, have an IPO, whether or not they're backed by VCs. And there is the mom and pop shops, the small businesses, the entrepreneurs, where maybe they just need 50K, 100K. They can open another coffee shop, another brewery, another location. Doesn't mean that they shouldn't be able to do that. I think from an investor's perspective, though, you need to understand, do you want to support the local businesses? Are you doing this because you want to be part of the mug club because you're happy to be an owner? Or are you trying to shoot for a higher investment return? Don't have to be mutually exclusive. Like you can get returns with some of these, but it's like those two types of businesses exist. And that's where Kingscrowd, we try and come in and help segregate those different opportunities. So as an investor, you have a good idea of, okay, am I investing in this one or that? Make sure you head over to Kingscrowd. We do help you to find those deals, diligence those deals, and then track your portfolio in one place. If you want more great data-driven insights like the chart and the news and everything we've been covering today, also head over to pitchreviews.com. Make sure you sign up for our free weekly newsletter, be delivered right to your inbox with all this great info. We'll wrap things up there for today. We'll see everyone back here next week.